Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. This has been a very interesting week. All three of the indices that we track, the NASDAQ 100, the S&P 500, and the TSX, have all risen to within 2 to 4% of their key index breakpoints. For the NASDAQ 100, that's the bubble price, or 7.4 times book, a very powerful support resistance level. For the Standard & Poor's 500, that is the super growth price, or 3.5 times book, probably the most significant breakpoint in SVA. And by the way, you can examine the mathematics of it in depth by Googling my monograph, Black Hole Economics. Finally, the TSX has risen to its high conservation price, or 1.45 times book, and probably the third most powerful breakpoint in our mathematics. And that's also touched on in Black Hole Economics. So what should we expect here from the FANG stocks? Not necessarily what has actually occurred, I do have to say. Anyway, before we take a closer look at those FANGs and what's going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Okay, the first thing that we would expect if the markets are coming up to key breakpoints is that a number of stocks would also come up to key breakpoints. And, well, we've seen this in three of the FANGs. First of all, here's Tesla, right up to its HB5. And today, take a look at what's happened there. Boom, a big drop. Okay, the second is NVIDIA, also moving up to its HB3, or 16 times book. Again, a nice setback in order, and looking at some of the semiconductor stocks, it's no surprise. Thirdly, it's Meta. Meta's been kind of feeble on either side of its super growth price, and with sliding fair market value potential. I'm not really anticipating much from that stock. So that's one kind of event that can happen. The second kind of event is that a stock that's been kind of shuffling along anyway, like Microsoft, may continue to shuffle, but it's not going to give us any kind of a signal one way or the other. The third kind of event that we might expect, of course, is that in a big market rally, the rich will get richer. And we indeed see this with Apple very nicely. And remember, I covered Apple in some depth last week. Now, the kind of event that I did not particularly anticipate is that some stocks would come up to breakpoints and then break out. So three of the FANGs did that last week. So let's take a look here. The first one is Alphabet. And yeah, the stock is broken out, but look at that technical platform. I'm not terribly surprised, actually, that Alphabet would come up to its MSG price, break out a little bit, and but maybe peak out, because there's going to be an awful lot of market technicians who are looking at this stock and expecting precisely that. The second stock to break out is Netflix, and of course we talked about that last week. Remember, I said, look, the super growth price was a 20-year target on the downside. Well, Netflix never quite got there, and I sort of kept wondering, like, why not? And then it occurred to me, if you have a 20-year expectation that a stock is going to reach a certain price to book low, it serves to be the case that there may be a lot of anticipatory buying of that stock, and it looks very much to me as that's exactly what's happened. Now, last week the stock broke out and pulled back, and I said, well, there you are. As long as the Netflix holds over its LSG price, which is 4.5 times book value, I think we have to stay with the stock, even though the fair market value is slipping. The big surprise to me was the breakout of Amazon. We had seen that the bubble price was its 30-year low, I think, and so that held all the way through, even though the break point was sliding, the balance sheet was slipping, and even though the fair market value has been going right into the ditch, but it held there very nicely. History casts a long shadow. It was the breakout that has surprised me quite a bit. However, that's what it's done, and SVA says, okay, I guess you got to stick with it, whether you like it or not. Now, in summary, what I generally expect to happen in market rallies, in what I think is a bear market, is first, stocks rallying right up to key breakpoints as the market reaches a peak. That's taking place, or has taken place, for Tesla, Nvidia, and Meta. Normally, I would expect a setback for those stocks. Secondly, stocks rallying, but not particularly robustly, which is happening with Microsoft. The third one, of course, is that in a market rally, the rich are getting richer, which is the story as far as Apple is concerned. I've liked this stock all the way along, and still do. The fourth is something I generally do not expect: stocks breaking out and giving technical buy signals at the possible peak of the market rally. By my way of thinking, Alphabet's breakout signal is weak, as there is some reason to anticipate an overshoot of its SVA breakpoint on purely standard technical analysis grounds. Netflix, of course, is an intriguing case. It bottomed roughly where I indicated it should, although a bit above a clean hit and rebound breakpoint, its super growth price, or 3.5 times book, its usual 20-year low. Last week, we saw that Netflix had broken out technically over its LSG price, 4.5 times book, more on hope than on results, as I said, but a confirmed breakout and pullback, which you can see here, is a breakpoint, and I would stay with the stock as long as the LSG price holds. It's Amazon which has amazed me. Its recent earnings and sales results were on the weakish side. Yes, they may have beaten so-called expectation, but their cloud division growth rate is visibly slowing, and general online product sales are slowing as well. One report that I read suggested that cloud computing capacity is reaching the same excesses that ultimately killed the dot-com era stocks when transmission capacity vastly exceeded demand. But whether that's true or not, and whether I like it or not, Amazon has indeed broken out. And so SVA says the stock is a buy hold unless the HB1 price, that's 10 times book, is violated on the downside. I've now reached up to 6 in enumerating the number of ways that SVA can earn its keep for you, all of which you now have seen in action in our FANG Friday YouTube series. The first is to help you find stocks to invest in. Second is to help you avoid the kinds of big losses that the market can inflict on your portfolio. Third, stocks in the same line of business frequently offer a strong indication of what may be about to happen to your stock, and you sometimes need to see what's going on in the industry. Fourth, bear markets are times of revaluation. Opportunities, including trading opportunities, frequently open up if you know what to look for. Fifth, those technical breakpoints can change, and do so notably in earnings season, as we clearly saw last week. SVA immediately updates you and keeps you in the loop. Sixth, and finally, of course, SVA can get you into or out of the stock market itself. Right now, the markets are all trading close to critical index breakpoints, and you may need to take defensive action. Now, if you'd like to join our investment community, go to www.strategicanalysis.ca/pricing and get started right away. This is not the type of market that you want to risk navigating alone. The potential losses are too great. So, join our investment community today. For now, this has been Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday.